All right, we're going to show you that rally in oil and energy this morning, what it's doing to the XLE, the OIH, the XOP. All of them are trading higher with crude oil coming off what is the best month it's seen since January. As, of course, we heard as well, OPEC set to extend oil supply cuts. Joining us now to discuss today's jump, Tamar Essner, Director of Energy and Utilities at Nasdaq Corporate Solutions, and John Hofmeister, founder and CEO at Citizens for Affordable Energy, the former president of Shell Oil. Tamar, let me start with you. Any takeaways from what at least we've heard so far out of Vienna and OPEC?
Well, certainly some very positive headlines for oil today from both a supply and demand perspective. With OPEC set to extend the production cuts, it's really just a question now of whether it's 6 months or 9 months. And obviously some forward momentum between China and the U.S. is important from a demand perspective, those two being the most important economies for oil from a demand perspective. So certainly I think we'll have a stronger week for oil. The question is whether the gains are sustainable based on the improvement in supply and demand, whether it's going to translate into anything on the fundamental side. We think that there's still some problems in both of those areas.
You do. Well, why is that? What are the problems?
Supply is problematic, manifold. First of all, when OPEC ultimately does end their production agreement, whether it is in 6 months or 9 months, they will go back to pumping and going back to a market share strategy, and they're going to be at a war with U.S. shale in that regard. That dynamic hasn't gone away. 2020 in particular looks particularly bearish from a supply perspective because you've got significant infrastructure in the U.S. pipeline that will connect U.S. shale to global markets. There's also other projects coming into play in Norway and Brazil. So 2020 doesn't look so great from a supply perspective. At the same time, it's great to have forward momentum with China, but I'm not sure that it really addresses the market's lack of confidence from a demand perspective. We've seen already that demand this year has slowed relative to last year, so we're still growing just at slower levels. And at the end of the day, production from the U.S. is still set to outpace the level of global demand growth. So I think that will be stronger in Q3. It's seasonally a stronger time of year, but whether we can sustain those gains in oil prices through the end of the year is the open question.
John, you can make the argument that from 2014 to 2016, we saw a face-off between U.S. shale and OPEC. And yes, it was very painful, I think, for all involved. But now we're pumping record amounts of oil here in the U.S. So shale has continued to hang in there. When you look at the dynamics between Russia and OPEC, Iran and Saudi within the cartel, can it continue to exist as it currently is?
Well, I think for now the answer is yes, it can, because Iran has no choice but to take a backseat to the Saudis and to the Russians. And the Russians and the Saudis have indicated with their agreement for the next 6 to 9 months to really go for revenue. They really do need the revenue to keep those governments afloat and to keep the quality of life that they're expecting from oil to be about what it has been, which is, you know, pretty luxurious because we're paying for it. They're not. We are. But I think with regard to shale, we should not be too over-optimistic on the success of shale because we're still not making very much money producing shale. There are quite a number of producers that are still experiencing negative cash flow because their loan commitments really chew up all the cash they make. And if they're not capital rich, then the idea of drilling new wells, because the decline rate is so high, becomes quite problematic. So I don't think we're out of the woods yet from the 2014-16 period, because it's not a great rich experience for the U.S. industry in the shale formations.
Tamar, is that the reason why energy stocks in the S&P have been the worst performing sector for the last 3 months?
I think that's a big part of it. Also, if you look at the futures curve for oil, prices slope downward. We're in a state of backwardation. Energy equities tend to be forward-looking. So if you look at prices in the 2022 environment are trading in the low 50s. That's basically just about break-even levels for a lot of shale companies. It's difficult for them to hedge. So I think that is problematic. Also, I know on your program you've talked a lot about energy being such a small component of the S&P 500. So even if you are bullish on energy, if you make a material overweight position, it's still hard to beat your benchmark index if the underlying component stocks are such a small portion of that index. So I think that that is something that will hamper individual energy equities, but I do think that shale will continue to grow for 2019 at a level that exceeds global demand growth, which is part of the problem for oil as a whole.
Yeah, Mike, we're what, 5% now, right, on the waiting for oil?
That's right. Yeah, and the S&P 500.
Just
Double that
below
not that long
5%.
ago, right? Yeah. Tamar, John, thank you both this morning. Appreciate it.